I need you to stop looking at the recovery. I need you to stop celebrating the bounce from $71 back to $82. I need you to stop thinking that the worst is over. Because what happened to silver over the last 2 weeks is not just a correction. It is not just a healthy pullback. It is not just volatility. What happened was a slaughter. It was a margin call massacre. It was the single worst day for silver since 1980. And if you do not understand what caused it, if you do not understand the mechanics of how the price went from $121 to $71 in 48 hours, you are going to get crushed the next time it happens. And it will happen again. Let me walk you through the crime scene. On January 29th, 2026, silver hit an all-time high of $121 per ounce. It was a moment of euphoria. The precious metals community was celebrating. Stackers were vindicated. The industrial demand narrative was winning. Solar panels, electric vehicles, AI infrastructure, everyone wanted silver. The price had more than tripled in a year. And then, on January 30th, the floor fell out. The crash began at 8:30 in the morning Eastern Time. President Trump announced that he was nominating Kevin Warsh to be the next chairman of the Federal Reserve. Warsh is a known hawk. He is on record saying that the Fed's balance sheet is too large. He has criticized the easy money policies of the last decade. And the market heard this announcement and interpreted it as a signal that interest rates would stay higher for longer. The selling started immediately. But the real panic did not begin until the afternoon. That is when the margin calls went out. You have to understand how the futures market works. Most traders do not buy silver with cash. They use leverage. They put down 10 or 15% of the value of the contract and borrow the rest from their broker. This allows them to control a massive position with a relatively small amount of capital. It works great when the price is going up. But when the price starts falling, the broker demands more cash to cover the loan. This is called a margin call. And if you cannot come up with the cash by the next morning, the broker liquidates your position. They sell your silver whether you want to or not. On January 30th, the price of silver dropped 5% in the morning session. That triggered the first wave of margin calls. Traders scrambled to wire cash to their brokers, but many of them could not. They were fully invested. They had no liquidity. So the brokers started selling. And when thousands of traders are forced to sell at the same time, the price collapses. Silver fell another 10% in the afternoon, and that triggered the second wave of margin calls. Now the panic was real. The selling became a cascade. By the close of trading, silver had dropped from $121 to $78, a loss of 35%. In one day. It was the worst single-day performance for silver since March 1980. That was the day the Hunt brothers' corner of the silver market collapsed. But the carnage was not over. On Monday, February 2nd, the selling continued. Silver opened at $78 and immediately dropped to $71, another 9% loss. The total decline from the peak was now 41%. 41% in 2 days. Trillions of dollars of paper wealth evaporated. Speculators were wiped out. Hedge funds blew up. And the mainstream media declared the silver bull market dead. But here is what they did not tell you. Here is what the talking heads on CNBC and Bloomberg did not explain. The fundamentals had not changed. The industrial demand for silver had not disappeared. The solar panel factories in China were still running. The electric vehicle manufacturers were still building cars. The supply deficit was still real. The only thing that had changed was sentiment. And sentiment is driven by leverage. Let me explain the mechanics of what happened. In the weeks leading up to the crash, speculative interest in silver had exploded. Retail investors were piling in. Day traders were using maximum leverage. Hedge funds were running momentum strategies. Everyone was long. And when everyone is on the same side of the trade, there is no one left to buy. The market becomes what traders call an air pocket. There is no support, no bids, just a void. And when the selling starts, the price falls through the air until it hits a level where real buyers are waiting. The real buyers, the physical buyers, the industrial users, they were waiting at $71. That is where the selling finally exhausted itself. That is where the leverage was flushed out of the system. And that is where the dip buyers stepped in. By Tuesday, February 3rd, the forced liquidation was over. The margin calls had been met. The weak hands had been shaken out. And the smart money started accumulating. Silver rallied 10% that day. Another 5% on Wednesday. And by Monday, February 9th, silver was back above $80. As of today, February 10th, silver is trading at $82. That is a 15% recovery from the low, but it is still 32% below the all-time high. So the question everyone is asking is this recovery real, or is it just a dead cat bounce? Is $71 the bottom, or are we going to retest that level again? To answer that question, you have to look at what has changed since the crash, and the answer is almost nothing. Kevin Warsh is still the nominee for Fed chairman. Interest rates are still elevated. The margin requirements are still higher. The CME Group raised the margin for silver futures from 11% to 15%. That means traders need more cash to hold the same position. That reduces the amount of leverage in the system, and lower leverage means lower volatility. But it also means less buying pressure. So why is silver recovering? Why did the price bounce from 71 to 82? Because the fundamentals are still intact. Let me walk through them one by one. First, industrial demand. Silver is not just a monetary metal, it is an industrial commodity. It is used in solar panels, electric vehicles, electronics, and medical devices. And the demand from these sectors is growing exponentially. The solar industry alone is expected to consume 30% of global silver production this year. That is a structural tailwind that does not go away just because the price crashed. Second, supply deficit. The world produces about 850 million ounces of silver per year, but the world consumes over 1 billion ounces. That is a deficit of 150 million ounces every year. That deficit has to be filled by drawing down above-ground inventories, and those inventories are shrinking. The registered silver in the COMEX vaults is at multi-year lows. The Shanghai Futures Exchange is nearly empty. The physical market is tight. Third, central bank buying. While central banks do not buy silver the way they buy gold, the spillover effect is real. When central banks buy 850 tons of gold, as they did last year, it validates the precious metals thesis. It tells investors that hard assets are a hedge against fiat currency debasement, and that demand flows into silver as well. Fourth, Japan just went all in on stimulus. Sanae Takaichi won a supermajority in the Japanese election. She is promising to spend 21.3 trillion yen on stimulus. She is suspending the sales tax. She is boosting defense spending. And defense spending requires silver. Missiles, radar, electronic warfare systems. Japan does not produce silver. They have to import it. So the Japanese government is about to become a major buyer on the global market. Fifth, the US-India trade deal. Trump and Modi announced a $500 billion trade agreement, and the White House fact sheet explicitly mentions precious metals. India is the largest importer of gold and silver in the world, and now they are committing to buy from the United States. That is a massive demand driver that the market has not fully priced in. Sixth, inflation expectations are falling. The 1 year ahead inflation expectation in the US just dropped to 3.1%. That is down from 3.5% a month ago. Lower inflation expectations mean the Federal Reserve has more room to cut rates. And lower rates are bullish for silver, so the fundamentals are strong. The demand is real, the supply is tight, and the macro environment is supportive. But there is one thing that could derail the recovery, and that is another wave of forced selling. Because the leverage has not been completely flushed out of the system. There are still speculators holding positions. There are still hedge funds running momentum strategies. And if the price drops below $75, the margin calls will start again. That is why $75 is the key level to watch. If silver holds above 75, the bulls are in control. If it breaks below 75, we could retest 71 or even go lower. But here's the thing. Even if we do retest 71, even if we see another wave of selling, the long-term trajectory has not changed. Silver is in a structural bull market. The fundamentals are too strong. The supply deficit is too real. The industrial demand is too powerful. This is not like 2011. In 2011, silver went from $50 to $26 and never recovered. Why? Because the demand was speculative. It was driven by retail investors chasing the price. There was no structural supply deficit. There was no industrial demand boom. It was a bubble. And bubbles pop. But this time is different. This time the demand is real. The solar industry needs silver. The EV manufacturers need silver. The defense contractors need silver. And they do not care if the price is $80 or $100. They need the metal. They will pay what they have to pay. So the crash from 121 to 71 was not the end of the bull market. It was a reset. It was a shakeout. It was the market purging the weak hands and the over-leveraged speculators. And now, with the leverage reduced, with the forced sellers gone, with the physical buyers stepping in, the market is ready for the next leg up. But do not expect it to be smooth. Do not expect it to be linear. Silver is the most volatile major commodity in the world. It is more volatile than gold. It is more volatile than oil. It is more volatile than copper. And the reason is simple. Silver has a small market. The total value of all the silver in the world is tiny compared to gold or stocks or bonds. So when big money moves in or out, the price swings wildly. That is just the nature of the asset. If you cannot handle the volatility, you should not be in silver. You should stick to gold. Gold is more stable. Gold is less volatile. Gold does not drop 40% in 2 days. But gold also does not triple in a year the way silver did. If you want the explosive upside of silver, you have to accept the explosive downside. You have to be able to stomach the drawdowns. You have to be able to hold through the crashes. because the crashes are part of the process. They are how the market shakes out the weak hands. They are how the leverage gets flushed. They are how the real buyers get to accumulate at lower prices. So here's my take on where we are right now. The crash from 121 to 71 was brutal. It was painful. It was historic. But it was not the end. The recovery to 82 is real. It is driven by physical buyers. It is supported by strong fundamentals. And it has room to run. In the short term, we could see silver test $90 again. If we break through 90, the next target is 100. And if we break through 100, we are going back to the all-time high of 121. But we could also see another pullback. If macro conditions deteriorate, if the Fed does not cut rates, if the dollar strengthens, we could retest 75 or even 71. The key is to not get shaken out by the volatility. The key is to understand that silver is a long-term hold. It is not a day trade. It is not a momentum play. It is a structural bet on the breakdown of the fiat currency system and the rise of industrial demand for a finite resource. The analysts are still bullish. Goldman Sachs has a $5,400 target for gold. Bank of America has a $6,000 target. JP Morgan has a $6,300 target. And if gold is going to 6,000, then silver is going to at least 150, based on the historical gold to silver ratio. Some analysts think silver could go to 200 if the ratio compresses to 30 to 1 the way it did in 2011. Now let me talk about the technical picture. When silver crashed from 121 to 71, it broke through every support level. The 50-day moving average, the 100-day, the 200-day, all violated. Technical traders got stopped out automatically. That accelerated the decline. But when silver hit 71, it bounced hard. That bounce created what traders call a hammer candlestick, a reversal pattern. It signals the sellers, well, just exhausted themselves. Since that hammer formed on February 2nd, silver has been making higher lows and higher highs. That is an uptrend. If this continues, the next resistance is $90. Break through 90 with conviction, and the path to 100 opens. But the psychological damage is real. Traders are traumatized. They remember losing 40% in 2 days. That fear creates resistance. Every time silver approaches a previous high, people take profits. This is recency bias. People think what just happened will happen again, and that creates selling pressure at key levels. But here's the thing. When everyone is scared, the smart money accumulates. Right now, the silver market is fearful, and the smart money is buying. The physical market is tight. Dealers report strong demand for coins and bars. Premiums are elevated. Delivery times are stretching, or real buyers are accumulating. This is how bottoms are formed, not with euphoria, but with fear and doubt. So the long-term picture is clear. Silver is going higher, much higher. But the path is going to be volatile. The road is going to be rocky. And you have to be prepared for more crashes like the one we just saw. Because this is silver. This is the most explosive, most volatile, most hated, and most loved metal in the world. And if you are going to play in this market, you better have strong hands.